When most people think about financial bubbles, three great archetypes spring to mind. The Dutch Tulip Mania of the 1630s, the South Sea Bubble of 1720, and the Dotcom Bubble of the late 1990s. These episodes have become cultural shorthand for speculative excess, irrational markets, and the dangers of chasing easy wealth. Tulip bulbs selling for price of a house, South Sea shares doubling in days, or internet startups with no profits reaching billion-dollar valuations. These are the cautionary tales that textbooks, documentaries, and even dinner party conversations return to again and again. But by focusing only on these greatest hits, we miss a much deeper, richer, and more troubling truth. Bubbles are not rare outliers, but a recurring pattern in economic history. They happen across centuries, in wildly different industries, and even in societies that thought themselves immune. Why? Because financial bubbles are less about the asset being traded, be it flowers, land, or software, and more about human psychology, collective belief, and a seductive story that this time is different. As we explore these forgotten bubbles, from France's paper money experiment under John Law, to Britain's canal and railway frenzies, to speculative land rushes in Melbourne and Miami, to blue-chip delusions and Japanese skyscrapers, we will see that the lessons are timeless. Each bubble reveals the interplay between innovation, policy, and psychology, and each collapse exposes a fragile foundation of collective belief. In the end, the true subject of bubbles is not money, but mass psychology. Let's now take a look at the largely forgotten bubbles, and then, in this video, examine the root causes and psychological mechanisms that led to their formation. At the dawn of the 18th century, France was financially exhausted. Decades of war under Louis XIV had drained the royal treasury. Into this crisis stepped a charismatic Scotsman, John Law, gambler, mathematician, economist, and visionary. Law convinced the French regent that paper money, backed not by gold or silver, but by the productive capacity of the French economy, could revive national finances. He created the Banque Générale, later nationalized as the Banque Royale, which issued paper banknotes exchangeable for coin. At the same time, he launched the Mississippi Company, a trading venture promising immense riches from France's North American colonies. Investors could buy shares in the company with the very paper money Law's bank produced. At first, this system seemed revolutionary. It expanded credit, increased liquidity, and fueled a speculative boom. Parisian elites crowded the Rue Quincampoix, where Mississippi shares changed hands feverishly. Law was hailed as a genius, and the market capitalization of his company rivaled the entire French economy. But the bubble contained its own seeds of destruction. The supposed wealth of Louisiana was largely imaginary. Paper money multiplied far beyond its metallic backing, eroding confidence. When skeptical investors demanded coins for their banknotes, the Banque Royale could not deliver. Panic set in, the share price collapsed, and the French public lost faith not just in law, but in paper money itself. The Mississippi bubble demonstrates how state-backed monetary experiments can ignite speculative euphoria, and how quickly credibility can collapse. Its parallels to modern cryptocurrency booms are striking. New financial technologies, charismatic promoters, early fortunes made, mass participation, and then a sudden collapse when faith falters. Monetary innovation, as John Law learned, always depends on psychology as much as policy. Fast forward to the late 18th century, when Britain was undergoing the first industrial revolution. Canals were the arteries of progress, promising to connect mines, factories, and ports with unprecedented efficiency. The Duke of Bridgewater's pioneering canal to Manchester had shown the enormous profits and cost savings possible. Investors and engineers rushed to replicate the success. By the 1790s, Parliament authorized nearly 100 canal projects financed by subscription shares. Ordinary Britons, shopkeepers, farmers, tradesmen, poured savings into canal companies, convinced that waterways were the future. Yet not every canal had Bridgewater's economic logic. Many were redundant, poorly planned, or overfinanced. Competition between rival routes eroded profitability. Costs ballooned, revenues lagged, and investors who bought shares on the promise of endless growth faced bitter losses. Canal mania reveals the dangers of infrastructure hype. Just as 21st century investors have rushed into high-speed rail, smart cities, or even Hyperloop projects, the canal boom shows how enthusiasm for transformative infrastructure can outpace economic fundamentals. It also demonstrates a contagion effect. Once one canal succeeded, investors assumed all canals would succeed, a cognitive bias known as extrapolation. If canals were exciting, railways were intoxicating. By the 1840s, Britain's railway network was expanding rapidly, and the transformative power of steam locomotion was obvious. Faster than canals, cheaper than roads, railways promised not just profits, but a reshaping of time and space itself. Shares in railway companies became the speculative asset of choice. Ordinary families mortgaged homes to buy them. Newspapers dedicated entire sections to railway prospects. Public meetings resembled religious revivals, with promoters preaching the gospel of iron rails. The frenzy produced countless paper railways, companies that existed only on paper, with no track ever laid. Investors nevertheless subscribed enthusiastically, swept along by fear of missing out. Politicians and regulators, unwilling to dampen the boom, approved projects without due scrutiny. When reality failed to match expectations, collapse was brutal. By 1849, the stock prices of many railway companies had fallen by 2/3. Families were ruined, and the economic shock was severe. Railway mania shows how speculation thrives when innovation intersects with public imagination. It also highlights the role of information cascades, where individuals base decisions not on their own judgment, but on the observed behavior of others. This herd behavior, amplified by newspapers and public spectacle, remains central to every bubble. In the late 19th century, Melbourne was called Marvelous Melbourne. Fueled by gold discoveries and British capital inflows, the city expanded rapidly. Land values soared, and banks eagerly extended credit for property speculation. Suburban plots were sold and resold at ever higher prices, often without any development. Banks, flush with deposits from Britain, lent recklessly to property companies. By the late 1880s, Melbourne had one of the most inflated property markets in history. The inevitable crash came in the early 1890s. Banks failed, foreign investors fled, and unemployment skyrocketed. The boom had been built not on productive development, but on speculative turnover of titles. The Australian land boom illustrates the dangers of global capital flows into emerging markets, a pattern repeated in Asia in the 1990s, and even in cryptocurrency markets today. It also shows the fragility of banking systems when exposed to real estate cycles. By the 1920s, Florida became America's playground. Railroads opened access, advertising promised sunshine and riches, and celebrities like Al Capone and the Harvey Firestone family bought estates. Developers sold swampy land sight unseen to northerners, often through glossy brochures. Speculation ran wild. Lots were flipped multiple times before being built upon. Prices detached completely from reality. Then in 1926, hurricanes devastated Miami and surrounding regions. Transportation bottlenecks, fraud, and overbuilding were exposed. The market collapsed, leaving ghost subdivisions across the state. The Florida land boom shows the interplay between media hype, celebrity culture, and speculative frenzy. It foreshadowed later real estate bubbles, from Las Vegas in 2008 to crypto metaverse land in 2021. It also highlights the role of exogenous shocks, natural disasters, policy changes that can prick inflated markets. Unlike speculative canals or swampland, the Nifty 50 were real companies: IBM, Xerox, Coca-Cola, Polaroid. In the 1960s, these blue-chip stocks were seen as one-decision investments: buy and never sell. They were believed to possess permanent growth, immune to business cycles. Investors bid up their valuations to extraordinary levels, with price-to-earnings ratios exceeding 50. For a time, the illusion seemed justified. But by the mid-1970s, inflation, oil shocks, and slower growth shattered the myth. Prices collapsed, wiping out vast wealth. The Nifty 50 illustrates how even rational, profitable companies can become speculative assets when narratives of invincibility take hold. The parallels of today's Magnificent Seven tech stocks are clear: concentration, valuation excess, and the belief that technology guarantees perpetual growth. Sometimes, all it takes is one discovery. In 1969, Poseidon NL, a small mining company, announced a promising nickel find. Nickel prices were soaring due to demand from stainless steel production. Investors piled in, and Poseidon's share price rocketed from under $1 to over $280. Speculation spread to other mining companies, many with no real prospects. Small investors, eager not to miss out, bought in late. But Poseidon's ore was less rich than hoped. Nickel prices fell, and the entire sector collapsed by 1970. The Poseidon Bubble shows the dynamics of resource booms. Real discoveries can trigger speculative exaggeration. It also demonstrates the greater fool theory, where latecomers buy not for value, but in the hope of selling to someone even more optimistic. In the 1980s, Japan was at the peak of its economic miracle. Growth was rapid, technology exports dominated, and optimism abounded. Loose monetary policy fueled credit expansion, and both stocks and real estate prices surged. At its peak, the land under Tokyo's Imperial Palace was said to be worth more than all the real estate in the United States. The Nikkei stock index tripled between 1985 and 1989. But when the Bank of Japan tightened policy, the bubble collapsed. By the early 1990s, trillions in wealth had evaporated. The aftermath was devastating. Japan entered a lost decade, with deflation, stagnant growth, and a deeply scarred national psyche. The bubble showed how central banks can fuel and burst speculative manias, and how the cultural optimism of an economic miracle can blind a nation to valuation extremes. But how do financial bubbles exactly take shape? Which forces drive them forward? And how does human psychology amplify their rise and collapse? Let's dive deep into this phenomenon to uncover mechanics behind the mania. From the moment human beings began to trade, they discovered not only the thrill of profit, but also the peril of collective delusion. The history of financial bubbles is not merely an economic history. It is a history of human psychology written on the grand stage of markets. Again and again, societies have moved from optimism to euphoria, from panic to despair, and every stage reveals something profound about how people think, feel, and act when money and dreams collide. But why do these bubbles look so similar across centuries, whether in the tulip fields of 17th century Holland, the dot-com offices of Silicon Valley in the 1990s, or the cryptocurrency exchanges of the 2020s? To answer this, we need to dig into the mass psychology that fuels bubbles and the cognitive traps that ensnare even the brightest minds. The emotional cycle of a bubble is astonishingly predictable. It usually begins with optimism. A new opportunity arises, perhaps the discovery of gold in the rivers of California in 1849, or the launch of railways across Britain in the 1840s, or the emergence of blockchain technology in the 2010s. At this stage, investors genuinely believe they are funding progress. As early adopters see their fortunes multiply, optimism gives way to enthusiasm and then euphoria. Prices rise not because of fundamental value, but because more and more people are convinced they will rise further. At the euphoric peak, rational analysis is drowned out by a chorus of "this time is different," a phrase immortalized by economist Charles Kindleberger in his 1978 classic Manias, Panics, and Crashes. When doubts finally creep in, perhaps because of a failed harvest, a change in regulation, or simply because prices can climb no higher, the tone shifts to anxiety. Panic spreads quickly, often triggered by a few high-profile failures. Suddenly, everyone wants to sell, but there are no buyers left. What follows is despair. When prices collapse, fortunes evaporate, and participants swear they will never be so foolish again. Yet within a generation, the cycle begins anew. What makes this pattern so enduring are the cognitive biases that shape human decision-making. Behavioral finance, pioneered by scholars like Daniel Kahneman and Amos Tversky in the 1970s, has revealed that investors are not the cold rational calculators described in classical economics, but deeply emotional beings subject to systematic errors. Her behavior is perhaps the most obvious. When we see others making money, we assume they know something we do not, and we follow along. This instinct made sense for our ancestors on the savannah. If everyone runs, you run too. But in markets, it creates runaway feedback loops. Confirmation bias further accelerates the bubble. Once people are convinced of an asset's promise, they selectively absorb information that supports their belief and dismiss evidence to the contrary. Overconfidence bias adds another twist, as investors systematically overestimate their ability to time the market or to spot the moment when it is time to exit. In 1720, even Sir Isaac Newton, one of the greatest mathematical geniuses in history, lost much of his fortune in the South Sea bubble, reportedly lamenting that he could calculate the motions of heavenly bodies, but not the madness of men. Narratives and stories play a central role in overriding rational analysis. Economic historian Robert Shiller, who won the Nobel Prize in 2013, coined the term narrative economics to describe how contagious stories spread like epidemics, shaping investment decisions. During the dot-com bubble, the prevailing narrative was that the internet would reinvent every aspect of life, making profits almost irrelevant. During the housing bubble of the early 2000s, the story was that real estate values always rise. In the 1630s, tulips were said to be not just flowers, but symbols of status and eternal value. Media hype magnifies these stories. When newspapers, television, and later social media platforms constantly amplify tales of overnight millionaires, individuals feel what psychologists call social proof. If everyone else believes it, it must be true. Rational calculations about earnings, dividends, or realistic yields are drowned in a sea of memes, headlines, and anecdotes. New technologies and paradigm shifts are especially fertile ground for bubbles. Why? because they combine genuine innovation with boundless uncertainty. Railways in the 19th century, radio in the 1920s, semiconductors in the 1960s, and cryptocurrencies in the 2010s all inspired visions of a transformed future. Joseph Schumpeter, the Austrian economist famous for the concept of creative destruction, argued that capitalism advances in great waves of innovation. But when these innovations appear, no one can say with certainty which companies will succeed or how profits will be distributed. This ambiguity allows speculative narratives to flourish, as investors project their hopes onto any firm associated with a new technology. Thus, paradigm shifts create what Hyman Minsky later called displacement, a spark that ignites speculative manias. The role of FOMO, the fear of missing out, cannot be overstated. In modern slang, it is easy to dismiss, but the psychological mechanism is profound. When people see others enriching themselves, the pain of missing out feels greater than the risk of loss. The greater fool theory emerges, the belief that even if an asset is overpriced, one can still sell it to someone else at a higher price. This logic is self-reinforcing. The more people believe they can find a greater fool, the more they are willing to become fools themselves. That is why bubbles often escalate far beyond what any sober analysis would predict. One of the most haunting aspects of bubbles is that smart, experienced, and even cynical people participate. Why would sophisticated investors, hedge fund managers, and Nobel laureates throw money at assets they know are overvalued? The answer lies in institutional incentives and social pressure. Fund managers are often evaluated quarterly. If they refuse to join a rising market, they risk underperforming their peers and losing clients. John Maynard Keynes once quipped that markets can remain irrational longer than you can remain solvent. To sit out a bubble is to risk career suicide, so even the cautious join in. On a personal level, cognitive dissonance also plays a role. If everyone around you is getting rich, it is difficult to accept being the lone skeptic. The combination of professional incentives and personal psychology ensures that bubbles sweep up the best and the brightest. Can bubbles be recognized in real time or only in hindsight? Economists debate this fiercely. Alan Greenspan, then chairman of the Federal Reserve, famously warned of irrational exuberance in 1996, years before the dot-com bubble actually burst. Yet markets kept climbing. Identifying a bubble is easier in retrospect, but there are warning signs. Prices that rise far beyond historical averages, valuations disconnected from earnings, widespread use of leverage, and the proliferation of speculative instruments are all red flags. Minsky's financial instability hypothesis describes how stability itself breeds instability. Long periods of calm encourage risk-taking, which leads to fragile structures that eventually collapse. Still, these warnings are often drowned out during the euphoric stage, when critics are mocked as pessimists or dinosaurs. History offers sobering lessons about the timeless cycle of greed and fear. In every era, whether fuel Japan's rice markets, medieval Venice's spice trades, or Wall Street's mortgage-backed securities, the emotional DNA remains the same. Greed inflates the bubble, fear pops it, and despair clears the ground for the next cycle. Kindleberger and Minsky both emphasize that bubbles are not aberrations, but recurring features of financial history. They reveal not a flaw in markets alone, but in human nature itself. This leads us to the most important question. Can bubbles ever be avoided, or are they inevitable in capitalism? Optimists argue that better regulation, improved financial literacy, and advanced modeling can mitigate bubbles. Central banks now monitor systemic risks more carefully than in previous centuries, and stress tests aim to prevent collapses. Yet skeptics insist that bubbles are as inevitable as tides. As long as human beings dream of wealth, compete with peers, and fall prey to cognitive biases, speculative manias will return. Schiller has suggested that the best defense is not prevention but resilience, building systems that can absorb the shock when bubbles burst. In the end, the mass psychology of bubbles tells us a paradoxical story. On the one hand, bubbles are destructive, wiping out fortunes and destabilizing economies. On the other hand, they often leave behind lasting infrastructure and progress. The railway mania left Britain with a dense rail network. The dot-com bubble left behind fiber optic cables that powered the internet age. Even the cryptocurrency boom may leave us with valuable blockchain technologies. In this sense, bubbles are the irrational accelerators of human progress, born from the very same greed and fear that make us vulnerable. So when we ask why bubbles follow such predictable emotional stages, why they are fueled by herd behavior and confirmation bias, why stories and hype override rationality, and why even the smartest cannot resist, we are ultimately asking a deeper question. What does it mean to be human in the face of uncertainty and opportunity? The answer is sobering and exhilarating at once. We are creatures of hope and fear, endlessly repeating cycles of folly and innovation, condemned and blessed to ride the waves of manias, panics, and crashes. And perhaps, just perhaps, it is this very cycle that propels history forward. The true lesson of Forgotten Bubbles is not simply that markets are fragile, but that human psychology is predictable. Each generation believes itself wiser, more rational, and better informed. Yet time and again, the cycle repeats. As Charles Kindleberger wrote in his classic Manias, Panics, and Crashes, there is nothing as disturbing to one's well-being and judgment as to see a friend get rich. From John Law's Paris to Tokyo's skyscrapers, the story is the same. Financial bubbles are less about assets than about us. They are mirrors, reflecting our hopes, fears, and illusions. And until human psychology changes, the bubbles will keep returning,